Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my off-grid studio, getting our kicks on historic Route 66 with an explication request. If you have an explication request, you can send that to explicationrequest@guruexamprep.com. Here's today's request. This is kind of a tough one. I like this one. A customer buys one XYZ October 50 put at 1 and sells one XYZ October 65 put at 10 when XYZ is 58. Doesn't really matter in a speculative option strategy question where the price is when we do the trade. It matters where it's at when we close the trade, right? When it's all over. So it says 52 at expiration. That's what I like about the question. I call these time clock questions the customer has. I'm not asking what can happen to this customer, but what can happen to the 50 put? What can happen to the 65 put? What can happen to an option contract? Very important. A good memory aid device is T. The option can be traded. It can be closed. Either we're doing a closing purchase or a closing sale. The like on the time clock questions, that's what I call this. Several weeks later, you close out at intrinsic value or at expiration. That's what I call a time clock question. The contract can be exercised. The contract can expire. So another phraseology they like is you close out at intrinsic value. The contract can be exercised. If at expiration the contract has intrinsic value, the contract will be exercised. I used to make my baby brokers write 1,000 times. Options are a wasting asset. Time value erodes. At expiration, the option contract is only worth its intrinsic value. And if there is intrinsic value, the contract will be exercised. Remember, in your option agreement, we tell you we have limited discretion to close out at expiration option contracts that have intrinsic value, or the option contract can expire. If at expiration the contract has no intrinsic value, the contract will expire. All right, well, let's see what we got going on here. We got a choice to sell the stock at 50. We got an obligation to buy the stock at 65. Same option, put, different actions, soda. This is a spread. It is testable to be able to identify this is a spread. A spread means difference. We're spreading the difference in the premiums. We fire up our T. Here's our 50 put. There's our 65 put. Remember, all the action takes place between the strikes. All of the action takes place between 50 and 65. There's our setup. We now know that this is a 9-point credit spread. So we know that we would hope the stock is 65 or higher, contracts expire, neener, we get to keep the 9 points. We would want the difference in the premiums to narrow, to get smaller. If I can close it out for less than 9, I'm a winner. My max gain is 9, my max loss is 6. The gain and the loss always equals the difference in the strikes. Now I'm doing it on a point per share basis, so that would be 900 and 600. We would be able to determine the break even. The break even is going to be pushed. Memory aid device, put, subtract from the higher. 65 minus 9, 56. And this is bullish. Larger premium dominates, which in this case is a short put. So all those things are testable. Let's get back to this question. So there's our market price of the stock, 52. We said all the action takes place between those strikes. That's the market price. Here's our break even. If somebody sticks it to me at 65 and I sell it to 56, I lose 9, I have 9, I break even. Nobody does things to break even. We want to know where it's profitable. We said this is bullish, so anywhere above 56, we're a winner. Anywhere below 56, we're a loser. So right now we can see that we have a 4-point loss here, a $400 loss. But I want to show you the mechanics of what this question says at expiration. All right, so now let's do what it says. Let's see what happens to our 50 put. I'm not going to exercise my choice to sell at 50 with the stock at 52. For the put to have a 50 put to have intrinsic value, the market price would have to be below 50, put down. The 65 put is certainly going to get exercised. I'm going to have an obligation to buy at 65, and somebody's going to put it to me, stick it to me at 65. The stock is worth 52. So that sounds not bueno, right? That's not bueno because, again, if we total up, I brought in a total of 60, I paid out a total of 66. I brought in a total of 62, 52 plus 10. So I lost 4 points, right? There's our puts exercise, there's the market price. And so the answer to the question is we have a $400 loss. So again, what I like about this question is a lot on these time clock questions, a lot of them will say several weeks later or at expiration. Usually when they say several weeks later, they say close out at intrinsic value. Right now, we didn't deal with the intrinsic value, but the intrinsic value of that 65 put with the stock at 52 is 13 points. So if they would have said close out at intrinsic value, that'd be 13. Right. So I like the phraseology. Once you get comfortable with this phraseology, remember inch by inch, expiration is a cinch, yard by yard, expiration is hard. And I'll see you for the next explication request.